Following the COVID-19 pandemic, the global economy fell into a deep recession. For the US, this turned out to be the shortest recession of all time, met with the combination of central bank and government intervention. And by the summer of 2020, growth and inflation began to rise, supported by lower rates, rising liquidity. These were very supportive financial conditions. This allowed the economy to expand and support bull markets in stocks, crypto, and commodities. Risk assets were ripping higher. And this is macro summer. US bonds and dollars underperformed during this season because they're risk-off, safe haven assets, recession hedges, and in macro summer, the economy is on fire. No need for bonds or dollars. Eventually, economic momentum peaked, while inflation continued higher. This was the beginning of macro fall, a stagflationary environment. The economy was now contracting, financial conditions began tightening, marked by falling liquidity and rising long-term interest rates. For the most part, speculation for risk assets like crypto and stocks reached a peak and rolled over. But commodities responded a little different. Commodities are considered risk assets. However, they are the base inputs to the real economy. They are the source of inflation, which means the rise of inflation is in part the reflection of rising commodity prices. So commodities perform during macro fall. During this time, we can see that copper, oil, and natural gas went hand in hand with the rise of inflation. Now, the stock market as a whole underperforms in macro fall, but stocks are pretty versatile. There are sectors who benefit from rising prices. For example, in 2022, crude oil prices rose from the Russia-Ukraine war, which made oil and gas companies record profits, taking those stock prices much higher. Auto insurance rates surged, and Progressive auto insurance stock also rose. The cost of certain food items rose, and Pepsi stock went higher. The companies and commodities who happen to retain demand while prices rise can be considered an inflation hedge. Now, moving over to safe haven assets, we also have some differences. Currencies and bonds are safe haven risk-off assets, but during macro fall, bonds collapse for one specific reason. Bonds hate inflation. They cannot go up while inflation is rising, especially when the inflation rate is higher than the income payments yielding from the bonds. This makes them less attractive than other inflation hedges. Now, the dollar is also a safe haven asset or recession hedge, and it can rise during macro fall, mainly because rising interest rates can tilt the economy closer to recession, and investors would rather hold cash if things turn sideways. Plus, they can earn interest on their cash deposits risk-free because the dollar doesn't really move. Macro fall is considered a stagflationary environment, meaning the economy is stagnant while inflation rises, and this prompts central banks to hike interest rates to slow down inflation, which tipped the economy further into recession. Winter was coming. Finally, inflation reached its peak and rolled over. These are the conditions where recessions are most likely to happen, where risk assets typically reach their lowest point and safe haven assets reach their highest levels. Welcome to macro winter. During this phase of the economy, financial conditions begin to ease as long as inflation is no longer a threat. If they ease in time, recessions aren't that bad, and that's pretty much how this played out. Unemployment remained relatively low as inflation continued lower. Long-term interest rates reversed lower and liquidity stopped going down, creating an easing effect that allowed risk assets to finally bottom in anticipation of improving financial conditions. Although the Fed was still raising interest rates, it wasn't enough to offset the other sources of liquidity. See, the government started spending like a drunken sailor. This was fiscal liquidity, or the government spending to boost economic activity. This net easing of financial conditions helped stocks and crypto reach the bear market lows. This was the extent of the tightening, the low for stocks and the low for crypto. Winter was over without a massive recession, or was it? Now, the economy was still vulnerable because the Fed was still raising interest rates, and long-term rates started tightening again. In March of 2023, the US saw the second largest banking crisis in history, rivaling the 2008 financial crisis. But then the Fed unleashed $500 billion of liquidity to stop the crisis. Inflation was still falling and GDP growth started to accelerate. This was macro spring, the disinflationary boom, the beginning of a new bull market. Eventually, the Fed stopped tightening, liquidity continued to rise, supporting risk assets to keep on ripping higher. If we take a step back, we can see all 4 seasons play out within a 4-year period. Take your time, study this. Now, the seasons don't always fall in order, but internalizing the mechanics of growth, inflation, rates, and liquidity gives us an edge. When the mechanics change, we change. Now, you might be thinking, how do I measure growth? How do I measure inflation? How do I view liquidity or interest rates? That's exactly what we're going to dive into in the next lesson.